Hey guys! Welcome for another episode of Financial Accounting Tutorials. So, today we are going to talk about inventories. So, what is inventories? According to its governing standard, PAS 2, it defines inventories as assets that are held for sale in the ordinary course of business. It is also known as the finished goods inventory. They can also be in the process of production for such sale, also known as the work in process inventory. Or they can also be materials or supplies to be consumed in the production process for such sale or for rendering of services. For us to know the owner of such good, we should consider some instances that would lead us to the right owner. Goods in transit. These are goods already ordered by the buyer and shipped by the seller. However, the buyer has not yet received these goods as of the reporting date. Now, the ownership of these goods depends upon the term of sale contract. It can either be FOB shipping point or FOB destination. Now, FOB shipping point, this is where the ownership of the goods is only transferred upon shipment. While FOB destination, ownership of the goods is transferred only when the buyer receives the goods. Thus, on the day of shipment, the buyer is already the owner of the goods. That is the FOB shipping point. But in an FOB destination, the seller would still be the owner of the goods until the buyer receives it at his door or at the location contracted by the seller and by the buyer. Now, consigned goods. What is consignment? Consignment is when a consignor, the owner of the goods, transfers his goods to a consignee. The consignee will act as the agent of the consignor in trying to sell the goods. Although the goods were physically transferred to the consignee, there was no transfer of ownership. Thus, the consignor is still the owner of the goods. Now, inventories held or sold under financing agreements. For inventories held or sold under financing agreements, such as selling the goods but assuming an obligation to purchase them back, or using the goods as collateral for a loan, the borrower is still the owner of the goods and it will not be transferred to the lender. The buyer does not recognize inventory when, for example, goods are defective or unsaleable, or when he intends to return the goods within the limit allowed under the sale agreement. Next is the inventories held or sold under installment. The goods are excluded from the seller's inventory account and is already included in the buyer's inventory account. The legal title of the goods is retained or withheld by the seller only to protect the collectibility of such sale. Next, we have the bill and hold agreement. This is a contract of sale wherein the entity builds but retains physical possession of the product. In the bill and hold agreement, goods are excluded from the inventory of the sellers and included in the inventory of the buyer. Lastly, we have the layaway sale. This is a type of sale wherein goods are delivered only when the buyer makes the final payment in a series of installments. Now, how do we recognize or how do we measure inventories initially or upon buying the goods? So in accounting for inventories, at initial measurement, the goods purchased are recorded at cost. The cost of inventories includes cost of purchase, such as the purchase price, import duties, and other non-recoverable taxes. We also have the cost of conversion. This is the cost of converting raw materials into the work in process inventory and into finished goods inventories. The very purpose for accounting inventories is to determine the proper amount to be recognized in the financial statement. In accounting for inventory, the entity could either use perpetual inventory system or the periodic inventory system. Using the perpetual system, the inventory account is updated every time a transaction occurs, such as purchase or sale of inventories. In effect, it can easily determine the inventory on hand and the cost of goods sold without the need of physical count. However, the entity may still conduct a physical count to determine the right amount of inventories that they have at the end of the period. Any difference from the physical count and from the records in the book will be charged to the cost of goods sold. Furthermore, any differences are charged to the cost of goods sold in cases of normal spoilage or loss of the inventory due to abnormal spoilage such as theft. So, for a periodic inventory system, this is commonly used for inventories that are specifically identifiable and are relatively high valued, such as cars, machineries, furniture, and heavy equipment. Under the periodic inventory, the inventory account is only updated at the end of the accounting period through the conduct of a physical count. Thus, the inventory on hand and cost of goods sold can only be determined after the physical count. So to record the journal entries, under this system, the inventory account is not continuously updating until the end of the accounting period. Thus, inventory account is not used. This is only the difference in between the two systems. For freight-in, we also have a separate account for that. Now let's move on to cost formulas. There are two methods used in practice for the proper identification of cost, namely FIFO and weighted average method. FIFO means first in, first out method. This means items bought first are most likely to issue first to customers. The cost of goods sold is computed by the cost of the items that were first or earliest purchased. Conversely, the cost of the items last or most recent purchase represents the amount of the ending inventory on hand. Note that the cost of goods sold and ending inventory are the same whether you use the perpetual inventory system or the periodic inventory system. The weighted average method, under this method, the cost of each item is determined from the weighted average of the cost of similar items at the beginning of a period and the cost of similar items purchased or produced during the period. In this method, cost determined using periodic inventory system is different from the cost determined using perpetual inventory system. Under periodic system, the cost of goods sold and ending inventory can only be determined at the end of the accounting period. While under a perpetual inventory system, the weighted average cost is determined every after purchase of inventory. As of the date, the moving weighted average cost is then multiplied to the quantity sold to determine the cost of goods sold or the inventory on hand for the ending inventory. And our last topic for this episode is the estimation of inventories. The estimation of inventories is permitted under the governing standard of inventories Fast 2 only when they approximate cost. There are two ways to estimate inventories, namely the gross profit method and the retail method. In gross profit method, the gross profit rate or GPR is used to compute for the cost ratio, which would in turn be used to estimate the cost of ending inventory and cost of goods sold. There are two ways to express gross profit rate as a percentage. It can either be based on sales, wherein the GPR based on sales is deducted to 100% net sales to derive the cost ratio. The other way to express GPR is based on cost of goods sold. The COGS is computed by dividing net sales by 100% plus GPR based on sale. The other method of estimation of inventories is the retail method. This is often used in the retail industry for measuring inventories of large numbers of rapidly changing items with similar margins, for which it is impracticable to use other costing methods. The peculiar thing about retail methods is that gross profit is disregarded in determining cost ratio and the concept of net markups and net markdowns. Markup is the increase above the original retail price, while the markdown is the decrease below the original retail price. Markup cancellation is a decrease in the selling price but not below the original retail price. A markdown cancellation, it is an increase in selling price but not above the original retail price. This is deducted to the markdown to determine the net markdown.
Comprehensive problem for inventories. Tiger Company sells guitars. The company's reporting date is December 31. All customers are within a 15-day delivery area of the company. On December 1, 2016, inventory on hand consisted of 50 guitars at 1,500 pesos each and 75 guitars at 1,550 pesos each. Shipping fees per transaction amounted to 150 pesos. During the month, the following transaction took place, while all purchases and sales transactions are on credit. On December 1, 2016, they sold 20 guitars for 1,750 pesos each, FOB destination freight prepaid. On December 3, 2016, they sold 45 guitars for 2,500 pesos each, FOB shipping point freight collect. On December 6, 2016, they purchased 150 guitars from Patnelco Company at 1,600 pesos each, FOB destination freight collect. On December 9, 2016, they sold 35 guitars for 1,800 pesos each, FOB destination freight collect. On December 10, 2016, they received the guitars purchased from Patnelco Company on December 6, 2016 and found out that 25 of the guitars are damaged and was immediately returned to Patnelco Company. On December 11, 2016, guitars valued at 36,200 pesos were received from believed company under consignment terms. On December 17, 2016, 7 guitars sold on December 1, 2016 were returned by customers. On December 18, 2016, they sold 70 guitars for 1,650 pesos each on their FOB destination freight prepaid. On December 22, 2016, guitars costing 40,000 pesos are sent to Cael Company under consignment terms. Requirements: compute the cost of goods sold under the following independent cases and provide the necessary journal entries. Using the FIFO cost formula under perpetual inventory system and under periodic inventory system. Using the weighted average cost formula under perpetual inventory system and under periodic inventory system. For the first requirement, using the FIFO cost formula under perpetual inventory system, as of December 1, we debit prepaid freight 150 pesos and credit cash of 150 pesos. On December 3, we debit accounts receivable and credit sales at 112,500 pesos. We also debit cost of goods sold and credit inventory at 68,250 pesos. On December 10, we debit inventories at 240,000 pesos and we credit accounts payable at 239,850 pesos and credit also cash at 150 pesos. Also, on December 10, we debit accounts payable of 40,000 pesos and credit inventories at 40,000 pesos. We will not have any journal entries for December 11. The goods given by believed company are under consignment terms. On December 16, 2016, we debit our accounts receivable and credit sales at 35,000 pesos and we also debit cost of goods sold and credit inventory at 30,000 pesos. We also debit our freight out and credit prepaid freight at 150 pesos. On December 17, 2016, sales is debited at an amount of 12,250 pesos and we credit accounts receivable of 12,250 pesos. We also debit inventories and credit cost of goods sold at an amount of 10,500 pesos. On December 18, 2016, we debit freight prepaid and credit cash of 150 pesos. On December 24, 2016, we debit accounts receivable of 62,850 pesos and also freight out of 150 pesos, and we credit sales of 63,000 pesos. We also debit cost of goods sold at 54,250 pesos and credit inventories at 54,250 pesos. To further understand the amounts computed, refer to the table as shown. For the next requirement under FIFO cost formula is under periodic inventory system. For the computation of cost of goods sold, we add the beginning inventory amounting to 191,250 pesos to the net purchases of 200,000 pesos to have our total goods available for sale amounting to 391,250 pesos. Then we deduct it with the ending inventory amounting to 139,200 pesos, and our cost of goods sold is equal to 252,050 pesos. For the journal entries, on December 1, 2016, we debit prepaid rate and credit cash of 150 pesos. On December 3, 2016, we debit accounts receivable and credit sales of 112,500 pesos. On December 10, 2016, we debit purchases of 240,000 and we credit accounts payable and cash of 239,850 and 150 pesos respectively. Also on December 10, we debit our accounts payable of 40,000 and we credit purchase return of 40,000. On December 11, there will be no journal entries as the goods given by believed company are under consignment terms. On December 16, 2016, we debit accounts receivable of 35,000 and credit sales of 35,000. We also debit freight out and credit prepaid rate of 150 pesos. On December 17, 2016, we debit sales return and credit accounts receivable at an amount of 12,250 pesos. On December 18, 2016, we debit freight prepaid and credit cash of 150 pesos. On December 24, 2016, we debit accounts receivable and freight out at an amount of 62,850 pesos and 150 pesos respectively, and we credit sales of 63,000 pesos. The next requirement is using the weighted average cost formula. Under periodic inventory system, we first need to compute the weighted average cost per unit, which is equal to the total goods available for sale amounting to 391,250 pesos over the number of units of 250 units, having a total cost of goods sold of 1,565 pesos. For the journal entries, the entries are similar with those in the FIFO periodic system, but with different amounts when it comes to sales. For the weighted average cost formula for perpetual inventory system, the unit cost changes every after purchase. To better illustrate this, please refer to the table as shown. For the journal entries, on December 1, 2016, we debit prepaid rate and credit cash of 150 pesos. On December 3, 2016, we debit accounts receivable and credit sales at an amount of 112,500 pesos, and we also debit cost of goods sold and credit inventory at an amount of 68,850 pesos. On December 10, 2016, the inventory is debited and accounts payable is credited at an amount of 240,000. Consequently, inventories is again debited and we credit cash at an amount of 150 pesos. Also, we debit accounts payable of 39,750 pesos and credit inventory of 39,750 pesos. On December 16, 2016, we debit accounts receivable and credit sales of 35,000 pesos. We also debit our cost of goods sold and credit inventory at an amount of 30,600 pesos. On December 17, 2016, inventory is debited at an amount of 10,710 pesos and the cost of goods sold is credited at the same amount of the inventories. We also debit our sales returns and allowances of 12,250 pesos and credit accounts receivable of 12,250 pesos. On December 18, 2016, accounts receivable is debited an amount of 115,650 pesos and we credit our cash and sales at an amount of 150 pesos and 115,500 pesos respectively. The cost of goods sold is also debited at an amount of 111,112 and 40 centavos and the inventory is also credited at the same amount. On December 24, 2016, accounts receivable is debited at an amount of 63,000 and sales is credited at an amount of 63,000 pesos. We also debit our freight of 150 pesos and we credit our accounts receivable at the same amount. Cost of goods sold is also debited and inventories is also debited at an amount of 53,550 pesos.
So that's all for this episode. We hope you enjoyed and learned so much. Don't forget to subscribe and give a thumbs up if you like this video.